you're sick of riding the Wall Street roller coaster, you're not alone. The wealthiest investors in the world don't rely on stocks alone to get rich.
The stock market? Ugh.
In fact, while the average American has 95% of their investment portfolio tied up into stocks and bonds, the top 0.1% of the wealthiest Americans have a mere 30% of their portfolio tied up into the public markets. So where is that other 70% invested in? Well, that's exactly what we're going to be covering in today's video. I'm going to be sharing with you the alternative investing strategies that the wealthiest Americans have been using for decades, and how you can use these exact strategies to finally escape the painful Wall Street roller coaster. For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of Gould Capital, and over the last 10 years, I've overseen over $250 million worth of real estate transactions here in Silicon Valley, and also been a managing partner of a $300 million hotel portfolio. And in this time, I've had a tremendous amount of interactions with family offices, high net worth individuals, and ultra high net worth individuals. And I've had the opportunity to peek behind the curtain and see how these people think and what they're doing with their money. And it's nothing like you or I have ever been exposed to in the past. Now, I know what you're probably thinking, Danny, there's no way that I could ever possibly invest in something that the ultra wealthy invest into. I'm not a multimillionaire. I don't have millions and millions of dollars in the bank. And that's not true. This is a common misconception that you need millions of dollars to be able to invest into institutional caliber deals. A lot of these types of deals have a much lower barrier to entry, usually like a $50,000 to $100,000 investment minimum, which isn't chump change by any stretch of the imagination, but sure a hell of a lot less than millions and millions of dollars. And it's certainly a lot less than most people would anticipate. Okay, so now that we've got that out of the way, let's dive into some of the alternative investment vehicles that the ultra wealthy invest in. First up, in the investment vehicle that I particularly specialize in are commercial real estate syndications. You ever see like a massive hotel or a towering skyscraper or a huge office building and drive past it and think, I wonder who owns that? Chances are it wasn't just one person that owned that building, but rather a group of investors structured through what's called a real estate syndication. Now, I know the term real estate syndication sounds really complicated, but it's actually very simple in nature. A real estate syndication is structured via a limited partnership model. It's very quite simple, actually. There are two sets of groups in a limited partnership structure, the general partner and the limited partners. Now, the general partner is responsible for carrying out the entire business plan. They are the executors, and they're the ones that are actually getting their hands dirty and doing all of the work. They're in charge of acquiring the asset, they're in charge of managing the asset, they're in charge of selling the asset, and they're in charge of carrying out all of the details from start to finish. Meanwhile, the limited partners, their responsibility is simply to invest into the deal, right? And so you wire your money in as the limited partner, and then after that, all you do is collect checks. Sounds pretty awesome, doesn't it? There's no tenants, there's no responsibilities, no day-to-day headaches. As the limited partner, the general partner has the honor of carrying out all of the work. In a real estate syndication as a limited partner, some of the biggest advantages are true passive income. You know, with direct real estate investments like buying a single family home and renting it out, or a duplex and renting it out, even if you have a property manager, there's still a lot of things that you are responsible for as the owner of that property. And all of those headaches, all of those hassles go away when you invest into passive real estate opportunities like real estate syndications. That being said, basically all the same tax advantages that you get by owning your own real estate, you also get by investing into passive real estate opportunities like real estate syndications. Depreciation, cost segregation, all of those tax advantages are passed on to the limited partners pro rata based on the amount that they invested into the deal. So you invest into, say, $1 million deal, you invest $100,000, you get 10% of all of those benefits, right? And I'm really simplifying it. I'm dumbing it down for you. It's actually a lot more complicated than that, but you would get a pro rata share of the limited partners share of the tax advantages captured by that property. Now, obviously, for some people, having direct control over a property is what they want. And if that's something that you want, this kind of investment opportunity wouldn't make sense for you. But let's face it, the majority of people out there would much rather have their investments work for them as opposed to the other way around. Now, in tandem with real estate syndications, we have our next alternative investment class, which are real estate funds. Now, real estate funds are structured almost identically to a real estate syndication, but as opposed to investing into one particular property as a limited partner, the general partner presents a business plan to the limited partners and says, we're going to buy 5 properties, let's say, and go out there and buy 5 properties, and we're going to execute this same business plan. We have this investment thesis, and we're going to execute this business plan on these 5 properties. And the limited partners invest into the fund that the general partner then uses to go out there and buy these 5 properties. Now, one of the biggest advantages to real estate funds is that you spread your risk, you diversify your risk across multiple assets. And so the risk profile of a real estate fund is usually a lot lower than an individual real estate syndication. That being said, you still get all of the same passive income advantages that you would get from a real estate syndication by investing into a real estate fund. And from a tax perspective, real estate funds, you do still get to capture all of those same benefits, but the way in which they're distributed to the limited partners is a lot different. And so in real estate syndications, you usually get a lot of those tax benefits right away. And in real estate funds, you can often see a lot of these tax benefits be delayed because of the way that funds are structured. And that is a way more complicated topic than we really have time for in this video. But just know, a tax advantage perspective, syndications can be a little bit more tax advantage, but timing aside, real estate funds and syndications share a lot of the same tax advantages for the limited partners as well. Now, this is an incredibly simplified overview of real estate syndications and funds. And if you're looking for some more in-depth material, or maybe you're thinking, Danny, this sounds awesome and I want to understand how I can actually invest into these types of opportunities, I put together a 40-minute webinar exclusively for you. We break down how the wealthiest investors are leveraging real estate syndications and funds, create massive amounts of wealth while reducing their tax liability. So if you're wondering how you could get started with these passive real estate investment opportunities and really go in depth on how they're structured, make sure to check out the webinar in the description link down below. The next alternative investing asset class that the ultra wealthy absolutely love, and you've definitely heard this term before because it's a huge buzzword, is private equity. Now, I know private equity might sound very complicated, but the truth is it's very simple. You're investing into a company that invests into businesses before they go public, or you're investing into companies that invest into businesses that never go public at all. Now, let's say that a company is currently making about $5 million EBITDA, which is earnings before interest, taxes, depreciation, and amortization. If you're making $5 million EBITDA right now, let's say that private equity firm is able to take it to $10 million. Well, you've now doubled the company's value, and you might have even done more than double the company's value, because every business is valued at some sort of multiple of their EBITDA. And the more refined a company is, the better their systems and their processes are, and the more consistent that they are, typically the more they're worth on a multiple basis. And so when you're able to squeeze more juice out of the same machine, private equity firms are then able to sell companies for many multiples higher than what they acquired them for. So in the example that I just gave you, let's say that they bought the $5 million company at a 3x multiple, which would be $15 million. They then take that $10 million company and sell it for a 5x multiple, which is $50 million. They've now made $35 million on a $15 million investment. That's how private equity works, and that's why it's so lucrative. Now, outside of the big three, which are real estate syndications, real estate funds, and private equity, there are tons of other asset classes that fall into the alternative investment category. Art, watches, rare whiskey, private credit, private debt, seed round investments, crypto. These are all alternative investment categories that you can technically invest into yourself. Now, a lot of these niche investment categories are really diversification or wealth storage plays, not necessarily wealth creation plays. The core wealth building engine within alternative investments as a category really comes down to private real estate deals like syndications and funds, and private equity. I'll even throw in hedge funds and crypto, although those are much more volatile plays that really require a ton of expertise in order to discern which investments are worth it and which ones you should stay away from. Now, at this point, you might be thinking, Danny, if these investment opportunities are so good, why hasn't my financial advisor ever brought them up? Well, let me tell you a little secret. The reason your financial advisor hasn't brought these up before is because they don't get paid on them. Wall Street advisors earn fees when your money stays in their system. Stocks, mutual funds, ETFs, when you invest into those, they earn fees. But when you take their money and put it into private investments like real estate syndications or funds, they make nothing. So if your investment strategy up until this point has been take my money and give it to my financial advisor, they'll know what to do with it. Just know that they will never recommend these types of alternative investments unless you start taking control of your investment future. Now, I know what you're probably thinking, Danny, this sounds great, but like, A, how am I supposed to find these deals? B, how am I supposed to find the time to find these deals and find these types of opportunities? And not only that, but like, I don't even know what to look for. Like, I have very little knowledge to actually be able to assess these types of opportunities. And that's really, in my experience, what holds 99% of investors back. They lack the time, the knowledge, or the access to really invest into these types of opportunities. Because let's face it, these deals aren't showing up on E-Trade. They're not showing up on Robinhood. You have to know people that are in this world. Now, as I managed a $300 million hotel portfolio and was raising capital for that group, I recognized that this was actually a major problem out there, and that's why I started Gould Capital. We find great deals and analyze them, and when we find an opportunity that we're excited to invest into, we let our investor community know, and if any of them want to invest alongside of us, we invest together as a group. Now, my investor community is super exclusive. I don't let just anyone in, but if you're interested in learning more about how you could access my investor community and become a part of it, you can find a link to my calendar in the description box down below. Find a time to chat with me via Zoom, and we can see if it's a good fit. Now, I will say one of the requirements to join my investor community is that you at least make $200,000 a year or have a net worth of over $1 million. So you either have to make more than $200K a year or have a net worth of over $1 million. If you don't qualify under one of those two criteria, I'm sorry, but we would not be a good fit to work with each other at this point in time. Now, if you do qualify under one of those two criteria, go ahead and sign up down below to find a time to chat with me. Let's see if it's a good fit, and let's see if there's an opportunity for us to work together in the future. Because ultimately, you've worked way too hard to deploy outdated investment strategies. Now, if you've made it this far in the video and you're not yet subscribed to this channel, what are you waiting for? Click the subscribe button, hit the notification bell to get notified every single time I post a new video just like this one. We have tons of investment content coming your way and you don't want to miss it. This is Danny Gould, everyone, with Gould Capital, and I will catch all of you in the next video.